Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for March 2018. Let's take a look at key highlights of February. The Union Budget announced at the start of the month focused primarily on infrastructure, agriculture, and healthcare. Even though imposition of long-term capital gain and fiscal slippage proved to be the dampeners. Real GDP growth for Q3 bounced back to 7.2% from 6.3% in Q2, driven by a rebound in manufacturing and agriculture. A Rs 11,400 crore fraud came to light in the gems and jewelry sector, with alleged involvement of PNB officials leading to a massive sell-off in banks' bond and shares. Other bank bonds also saw a sell-off due to spillover effect. The US 10-year benchmark witnessed a sharp jump in yields, touching 2.95%, leading to a global financial market sell-off. The spike was on account of wage rise, leading to a pickup in expected inflation, causing expectation of more rate hikes by the US Fed than anticipated. Nifty witnessed a sharp correction this month, with the benchmark sliding by close to 6% during the month. The fall could be attributed to steep hike in US bond yields, imposition of LTCG, and relatively weak macros. The elusive earnings growth finally came with Nifty earnings growth of around 7%, while the broader market's BSE 500 saw 11% earnings growth and excluding financials saw a 14% earnings growth. We expect the momentum in earnings growth to continue with pickup in economic growth and fiscal stimulus. Short-term factors like derating of earnings multiple due to LTCG, spike in bond yields, and tapering in emerging market inflows are likely to lead to correction and consolidation in the short run. We are revising our Nifty target price for financial year 19 to 11,500 from 12,000 earlier. We continue to remain bullish on consumption, cement, building materials, and road construction sector. EPS estimates for Nifty index for financial year 18, financial year 19, and financial year 20 are Rs 499, Rs 608, and Rs 720 respectively. As per blended estimates, index is currently trading at PE of approximately 17.5 times 1 year forward. We recommend investors to deploy 33% of fresh equity allocation, while the remaining can get invested over a 3 to 4 month period in a staggered manner. The new 10-year benchmark GSEC has been extremely volatile and is hovering in the range of 7.40% to 7.80% on a semi-annualized basis. The yields have seen a jump primarily on account of slippage in fiscal deficit, aggressive selling by banks, and uptick in US Treasury yields. RBI in its monetary policy review maintained status quo with a hawkish undertone. The CPI inflation at 5.1% year-on-year was down sequentially by 0.2% due to lower food inflation. Core inflation remained sticky at 5.1%. The trade deficit at $16 billion burgeoned to a 56-month high as exports underperformed and imports traded higher, predominantly led by oil imports, which was up 43% to $12 billion. We expect benchmark yields to trade in the range of 7.50% to 7.80%. Yield movement hereon will depend on inflation trajectory, crude oil price, auction demand-supply dynamics, US Fed rate movement, and ECB's policy decision. We do not expect a hike in the near term as inflation is expected to remain within the target band. We recommend investors to allocate 100% of their fresh fixed income allocation to long-dated buy and hold strategies and active accrual strategies with low to medium duration.